Another day of trading is over at the New York Stock Exchange. The Dow Jones was in the red for most of the day and ended down about 164 points. The S&P 500 ended down 1.15% and the Nasdaq down 2.25%. Mark Hamrick, senior economic analyst and Washington bureau chief for Bankrate, joins us now. Hi, Mark. Great to see you again. So what drove the market down today?
Well, we don't like to place too much importance on one day's movement in stock prices. And remember, the market's actually rallied off of its recent lows. So the market's been performing a little better here of late. But the main impetus for caution here, I think, is the beginning of corporate earnings season coming up later this week. A number of big firms weighing in with their quarterly performance. And I think there's some natural caution given the fact that the economy is facing all kinds of headwinds these days.
And Mark, as you know, the Biden administration is looking into options for a global price cap on Russian oil. It will be tricky to implement because it means a full buy-in, but the move would presumably force Moscow to sell crude at a discounted rate. Do you think this sounds like a viable solution, and do you think it could help lower gas prices here in the U.S.?
Can't say I have a strong opinion about that, Tanya, but what I would say is presidents can't ultimately be very effective in controlling the prices of things. History has shown us that, and oil is going to be priced in the global marketplace, and ultimately what is going to drive that is supply and demand. Recently, we've seen some signs that demand has begun to wane a little bit here in the United States because of the high price of gasoline, and fingers crossed that we might see more of that. But if the economy truly weakens globally in the coming months, as some fear, then I would expect that that might be something that could drive down the price of gasoline. But this whole situation about energy, particularly Europe, is very dangerous right now, and there are all kinds of risks associated with it. And of course, people in Europe are wondering whether they're going to continue to have access to all the power they need.
Sure. And Mark, one of the things that interests me about, the economy or economic news is the tension between the perception or the expectation of what might happen and the actual reality of what's happening or what could happen. Because a new report is showing that consumers expect inflation rates to hit 6.8% in a year from now. That would be the highest the New York Fed has recorded in that expectations survey. Is there any merit in this assumption? Is this sort of just people's sort of worst fears running away with them, or could inflation reach those levels in 2023?
Well, I would say that our expectation broadly for inflation next year is that it will be less severe than what we're having right now. Of course, we have a read on the Consumer Price Index coming up later this week, in which it is expected, unfortunately, to hit a new four-decade high on a year-over-year basis. There is something important about that expectations report beyond what you mentioned, though, Tanya, and that is the intermediate and longer-term expectations for inflation on the part of consumers came down. So I think the Federal Reserve sees that and says, maybe the consumer actually believes that we have credibility with our inflation fighting process right now, principally rising interest rates. And I think on the part of the consumer, basically fearing consumer in the near term, they've been bludgeoned with this situation of late. So I think some fear is a rational response. It's an emotional response, but it's rational nevertheless.
Emotional and rational. Sometimes those two things don't go together. In this case, they do. All right. Well, Mark Hamrick, thank you so much. We appreciate your insight as always.
Thank you.